Joins in. Ajay, Pankaj here. Just wanted to start with the two recommendations that you have made earlier to us. One is Britannia, one is Motherson Sumi. Both of them have done very, very well. Do you still like both of these names? Britannia has been a three-bagger and Motherson Sumi is almost up about 70-80% from the last you recommended.
I think I would continue to recommend both Britannia and Motherson Sumi as a part of medium-term holdings and part of the core portfolio of our investors. In case of Britannia, I think we believe that there is still a 20% upside if one is willing to hold on for 1 year. For 1 year. And our analyst is penciling in a 15% growth in top line for the current financial year and around 17% in next financial year for Britannia, which will boil down to a bottom line growth, Pankaj, of around 23% for this year and a stronger 29% for next financial year. If you look at the return ratio profile of the company, ROEs, they're extremely strong at 45.5% for the current year and will remain sort of steady for the next financial year. And hence the stock trading at 28, although the stock trading at 28 times, we feel that there's a 20% upside with a 1 year perspective. The raw material scenario for Britannia is benign. As you know, agri commodity prices globally are at a 4-year low, and some of the main raw materials for Britannia, namely wheat, milk, palm oil, prices are trending down. Hence, I think that should help in terms of enhancement of margin profile for the company in the medium term. Coming to Motherson Sumi, I think we've been positive on it for last more than a year and a half now. We're still recommending it as one of our top picks. In Motherson's case, not only the upturn in the Indian economy spelling good news for the car industry in particular for the company, but also the extremely strong presence that they have in Europe, where they have got a couple of billion euros worth of orders, which will they start implementing very soon, which is keeping the interest in the stock from various institutional investors. I think insofar as Motherson is concerned, our analyst is penciling in a 18% CAGR in top line for FY 15-16, boiling down to bottom line growth of 18.5% this year and by a stronger 50.4% in next financial year. And the company's ROEs are trending upwards from 33.5% current year. We are looking at 38% ROE for Motherson next financial year. And the company is available at 21.7 times FY 16 PE. I think both of them should form part of a core portfolio.
Right. Ahead of the FOMC meet, we did had some good amount of correction coming in, but now we are up about 80 odd points in terms of Nifty. Mid cap and small caps are rebounding back. Do you think essentially that there was any positive thing from the FOMC takeaway for India, or it's just a relief sort of rally where people had got cautious ahead of that event?
Yeah, I think, Pankaj, as we headed into the crucial FOMC meeting yesterday, there was a sense of fear and trepidation among sections of market that the US may start raising rates sooner than what the market had factored in, which is sometime in the middle of calendar year 15. But having heard Janet Yellen yesterday and the dovish stance that she has taken in the face of strengthening US economy, where the inflation is still running below the Fed's target of 2%, I think the fears of any sudden reversal of carry trades and capital flows out of emerging markets, including India, seem to have abated to a large extent. And that is why, whereas yesterday we saw defensives doing extremely well and cyclicals being pummeled, today we are seeing again the risk assets doing well in the Indian context, and some of the cyclicals which had lagged over last couple of sessions sort of leading from the front, and it is the defensives sort of which have taken a breather. So I think it is more, as you characterized it, a relief rally, a relief from the fact that there will not be any sudden outflows of capital out of India. And let's not forget that $30 billion worth of total FI flows, equity and debt, has come into India from 1st of Jan. Roughly around 13.5 billion in equities and the remaining in debt. And hence, I think it's very important that the environment remains benign for capital flows to come into emerging markets and India. And yesterday's statement and the press conference clearly give an impression that the good times will continue to roll out insofar as capital flows to India are concerned. Along with the fact that the WPI numbers that came out just last week were at 5-year low at 3.57%. And more importantly, the food inflation numbers within that is at a benign 5%. So going forward, this should again feed into the CPI numbers where food forms 50%, and it will help RBI as you go forward in terms of their glide path of 8% inflationary target by December 16, and more importantly 6% by December 15. So as the market starts believing that the RBI will have more space in terms of adopting a more accommodative monetary stance, I think the equity markets will look at it positively, and the buoyancy in the equities in Indian context will continue to remain in the medium term.
Right. I just wanted to get your view on two stocks. One would be Maruti and the second would be Hero. Both of them are essentially hitting a new life high as we speak, and they have been doing quite well. Do you think optimism is priced in, or there could be still some steam left upside in the large cap auto space?
Yeah. I think Maruti in particular figures among our top picks. And there our analyst is expecting in a very short term a price of 3,200. We are basically looking at a strong revenue growth of around 15% in the current financial year, and around 19%, 18.7 to be precise, in next financial year in Maruti. Looking at a very strong 26.9% growth in bottom line in the current year, trending up to 32.6% in next financial year. And the stock has a steady ROE of 15%. And mind you, the ROE looks depressed because of the massive cash bulge that the company has accumulated. If you were to strip it out and then look at the ROEs look far stronger. Then the stock is trading sort of, at around 19.1 times FY16 earnings. So I think Maruti, in our opinion, offers a very strong entry point on dips. And one should look at it from a medium-term perspective. Insofar as two-wheeler space is concerned, I think our preference clearly lies with Maruti and at lower levels on Tata Motors, because we feel that it is the four-wheelers that will sort of show a far bigger jump in volumes as compared to two-wheelers over the next 6 to 9 months, and hence our preference will remain with Maruti than Hero Honda in the short term.
Right. You speak to a lot of domestic mutual fund, domestic players, who cater or take funds from retail. We just had Bala from Birla here who said that SIPs have increased, the sort of inquiries, inflows have increased. Do you get a sense with the retail money coming into the mutual fund side, mid-cap side of the market will get a support valuation, and corrections like we saw in the last few days will be bought into the quality names?
Yeah, I think I tend to agree with you. Because if you look at the broader market, I think the rise has been extremely sharp, and today you are trading at 16 times 1 year forward earnings. I'm looking at 504 rupees of earnings for Nifty in September 2015. So at the current level, roughly we're trading at 15.9 to 16 times. Now if you compare it to the last 10 years average, it is at 14.9 times. So we are currently trading at roughly 7% premium to last 10 years 1 year forward Nifty. Also, that's why sort of I feel that the rise in the broader indices will be more calibrated, will be more measured, and it will be more of a bottom-up picks rather than a wholesale re-rating that one has seen over last 1 year across sectors in case of large caps. In case of mid caps and small caps, on the other hand, we still are at a significant discount to the last peak that we had seen in 2008-2009. And hence, I think the possibility of you finding good bargains is much higher in case of mid caps and small cap space. But at the same time, Pankaj, one needs to caution investors to tread carefully out there and only look at those companies which have strong positive free cash flows, trending strong ROEs, strong earnings growth, and above all, very good corporate governance practices.
Right. Ajay, thank you so much for joining us here at NDTV Profit and highlighting the top picks at Prabhudas Lilladher.